Welcome to Investing 101. We're so stoked to have you here. I'm Brooke. I'm one of the co-directors and co-founders of Sharesies, and we've also got Brendan.
Hey there, I'm Brendan, Country Manager for Sharesies Australia.
And it's awesome to have you all here today.
Super awesome. Cool. So before we get started, I would like to acknowledge the traditional custodians on the land on which we come to you today, the Gadigal people of the Aurora Nation. And I pay my respects to their elders past, present and emerging, and I also extend that respect to Aboriginal and Torres Strait Islander peoples that may be with us today. Over to you, Brooke.
Our purpose at Sharesies is to create financial empowerment for everyone, and we're so stoked to have over 600,000 investors on our platform that together have invested over $2 billion. And our vision is to give someone with $5 and $5 million the same money opportunities. So we offer access to Australian shares, US shares, New Zealand shares, over 9,000 investment options. And what's super important about why we started Sharesies is we wanted to eliminate all of the barriers that people have in terms of developing wealth. And one of them is price. So we make sure there's absolutely no minimum you can get started investing with, no matter how much you have. We try and bust jargon as much as possible and use everyday language, and ultimately really want to create a platform that is available to anybody, whether you've been investing for a long time or just getting started. And on top of that, we're also really proud to be a B Corp, which means that we're a business as a force for good that really thinks about the impact that we're having and wanting to make a positive impact, both socially and environmentally.
Thanks, Brooke. Today we're going to break down what investing is, why people invest, and some key investing concepts. And we'll leave time at the end for Q&A. And the way to submit your questions for the Q&A is to use the Ask a Question button below. Don't leave questions in the chat as we might miss them. And remember, the only silly question is the one you don't ask, so don't be shy. Before we start, we just want to remind you that investing involves risks. You aren't guaranteed to make money, and you might lose the money you started with. Any information we provide today is general only and current at the time of providing it. If you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider, and we won't be providing any personal advice as part of this session.
So since we're all online, we want to get a bit interactive, so we're going to ask you to post in the chat. Post in the chat, what does investing mean to you? You can use emojis, you can write a sentence, whatever investing means to you. We'd love to start seeing that pop up. It's a great way to kind of break the ice and get started before we kick into talking a bit more about what investing is and a bit more about Investing 101. So, love this. And what does investing mean to you? Freedom, financial security in the long term for retirement, an opportunity to set my future self up. I love this. Financial security, long-term wealth creation. Oh, kia ora. Thank you so much for those awesome answers. Investing for the future, building wealth, setting up the future. Heaps to care around really thinking about that long term, that freedom, that future, the future possibilities, and creating those opportunities we want to have in our lives for those around us. So a bit more on what is investing. Investing, the concept of money is investing your money into something to potentially earn a return and grow your wealth over time. There's lots of different ways and things you can invest in. Often investing is associated with share markets, but it's also a lot broader than that. It can also be into property or bonds or commodities, and commodities are like gold and metals and things like that, or other things. It's anything where you're looking at, hey, how can I put my money to work more, both to create the society I want to live in and also to help create those returns so that I can have more opportunities in the future for whatever it is you want to achieve in your life. So a bit about why do people invest? It kind of comes back to all of those things that you mentioned before. Generally, people are investing to earn a return and grow their wealth. And we asked a bunch of investors, like we just asked you, what are the reasons that you started investing? And they're shown here, and this is exactly what we saw in the chat too, in terms of feeling financially secure, getting that higher rate of returns and savings, investing for retirement, investing for their children or their family's future, or like a real specific goal, houses or holidays as the world starts opening up again.
Cool. So you might be wondering what's the difference between investing and saving. Mostly comes down to risk and reward. When you put your money into a savings account, you can access it really easily when you need it. The risk of losing that money is really low, and you'll probably earn a little bit of interest on it too while it's in the bank. Historically, over the long term, though, assets like shares, property and bonds have generated higher returns than interest rates and savings accounts, but this comes with more risk. The value of these types of investments tend to fluctuate a little bit more, and there's a higher likelihood that you could lose some or all of the value. But it's not about picking one over the other. They all go hand in hand. Savings is about putting your money aside to use later. It's an essential part of financial well-being, and we'd encourage anyone to have an emergency savings account before you can consider investing. Investing is about making your money work and make money on the money and growing your wealth over time. Let's have a little look at what it looks like. So compound returns is about making your money work for you. So a good example of that is, let's say that we invest $100 and that makes an average return of 2% over the first year. So you get $2 at the end of the year. Then you reinvest that $2. So now you're investing $102 and you earn another 2% return on that over the course of the next year. And you've earned another $2 return from that on the $100, and then 4 cents from that return in the first year all up. So now your investment is worth $104.04. So that's money making more money. I like to think about it as kind of sourdough starter. Once you start it, it just keeps growing. And so that 4 cents might not seem like a lot of money, but over time it can really add up. That's the power of compound returns. And in fact, Albert Einstein is said to have called it the 8th wonder of the world. And that's why we love saying it's all about time in the market that beats time in the market every time.
Being gluten-free, I feel like I missed out on that sourdough buzz. So this is, when you're looking at investing and thinking about, what should you start thinking about before you start investing? It's really looking at your financial goals. And a lot of them were just mentioned then. It's like, are you investing to fund retirement, buy a house, create opportunities for your children, financial freedom, all of those interesting reasons we heard about why people are investing. It's really about thinking about what are my financial goals, or what are my goals in life that need money to be able to fund them. And it's real. And this really comes down to kind of knowing your why, knowing what do you need or want money for in the future? What are you trying to achieve with your investments, or achieve, with your family, your partner, yourself, your friends? And once you've got those goals in mind, it really helps you kind of set up your investment strategy. You start thinking about the time you've got and what you're wanting to be able to achieve through investing. Then the next thing to think about is, as we call it, risks meets goals and goals meet risks. So now you've got these goals in life, and start thinking about, well, what type of risk am I prepared to take in terms of going towards achieving that goal? Because all investing involves risk, and risk isn't a bad thing. It's just something that we need to understand and be comfortable with. And with investing, there's various types of risk out there. You can be low risk or high risk. So generally, if you're investing in things that are higher risk, it means there's potentially more reward. So the price of those investments are moving a bit more, and that means that there's potential that the price could go up higher, meaning you can get that capital gains from the price growing up higher than it was previously. And that's something that, but it does mean that there's, a little bit less certainty around taking higher risk investment options. There's also lower investment options and risk investment options. And on the Sharesies platform, you can see the investment ratings of all the investment options on our platform. And so lower risk means that you're, more likely to earn lower returns too. So it's all about thinking about your financial goals and the risks that you're willing to take to help you achieve that in life. And time is a key part of that. So the closer your time horizon, often the more you start thinking about, how much risk do I want if I'm really going to achieve this goal in the next 3 months versus over the long term. And I really like this graph because it shows the power of time really, really well. So this was the S&P 500 over the last 5 years. And you can see that time and risk are really, really important. Where if you invested, 5 years ago to now, you can see overall that graph has gone up quite a lot. But if you say invested when that, just at that top of that dip before the pandemic hit, and at the bottom, say between January and March, and you're in high risk investment options, it was likely that your portfolio would have gone down during that time. So a real key benefit when it comes to investing is that long-term horizon, and thinking, that you can weather these storms and build a diversified portfolio, which we're about to talk about.
Yeah, so we've all heard that saying, don't put all your eggs in one basket, and it certainly applies to investing. So diversification is when you spread your money across lots of different types of investments, and that spreads your risk. It means you're likely to take less of a hit if one or some of your investments lose value. And there's lots of different types of diversification. So there's the types of investments that you invest in, so shares, bonds, property, cash, different sectors, so retail, energy, banking, healthcare, and then also geographical locations, so New Zealand, Australia, the US, sizes of companies, big or small, the stage of a company, it might be a startup, it might be well established. And let's think of an example to do with the pandemic. So say someone only invested in tourism companies in one country. Then all of a sudden the pandemic hits, and as we know, tourism was brought to a standstill. Any company, any airline in tourism really started doing it tough. So that wouldn't be too great for this investor's heavily tourism-focused portfolio. But say they'd invested across a whole range of different investments, healthcare, medicine, sectors and countries. And in fact, tourism only made up a small part of the portfolio. The performance of those tourism assets wouldn't necessarily take the whole portfolio down. It would balance out the hit to the overall portfolio. So it wouldn't be as big as an impact on the investor's portfolio. And due diligence. So what's due diligence? And then we'll have a chat about dollar cost averaging. So due diligence is really just the research you do to decide whether you're going to invest in something or not. Lots of ways to do it, and lots of people talk to experts or their friends. You can Google a company, you can read annual reports if you really like annual reports. But what you do is you start understanding the story of the company, their strategy, the board, who might be involved, what the products are that they're having. You can think about yourself, like, do I buy these products? Do I think the company's doing really well? Just keep asking yourself questions like, what does the future look like for this company? Will they be around in 10 to 15 years? What do you think the risks are? And a really important thing nowadays is, what's the company's impact on the world? There's no right or wrong way to do due diligence, but it's just about gathering information just to help you decide if it's a right investment for you. And dollar cost averaging, like one of the magical things of investing. So we've mentioned that share markets move up and down. That happens all the time. It's just a regular market cycle. But the way that you can look at investing through the ups and downs of the market is, say on the slide, if you had $100 to invest. So the lower the share price is, the more shares you'd get for your $100. Now, if you could time the market perfectly, you'd always buy when the price is low and sell when the price is high. That's definitely not how I invest. You have to be pretty lucky to do that. So in this example, you'd invest your full $100, say when the share price is $2.50. In reality, that's really hard, if not impossible, to time the market. So dollar cost averaging is a strategy that can help remove this stress. And with dollar cost averaging, you invest a certain amount of money in a particular investment regularly, regardless of the share price. So if the price is high, you'll just purchase fewer shares, but you'll invest the same amount of money. And the price is low, you'll get more shares. So what it does, it just averages out your cost per share over time, so it's not all bumpy. It also means you're not waiting for the perfect time to invest. You can jump in and focus on investing an affordable amount regularly. So if you were to dollar cost average your $100 over the 5 months, say $20 a month, then this would be the impact of the share prices. So overall, the average share price over those 5 months is $10.50 per share. But if you're investing that $20 every month at the same time, you would buy 16.3 shares over those months, which means that that's an average of $6.13 per share. So that's a really good example of how that strategy can help you buy shares at a lower price. I'll just show you one of our features, which is auto invest. So one way you can put dollar cost averaging into play and make sure it's regular investing on our platform is by using auto invest. So once you log in, you land on your home page, you'll see a tile called auto invest, which you can click through here. There's a DIY, a pre-made order pack, and it has a range of ASX investments. So right now we're in the DIY auto invest bit. You can filter investments by categories. So let's have a look at some ETFs in this case. I'll choose 2. And then decide the split that I'd like to invest in. So we'll go 50-50, don't pick a favorite, and then confirm the amount that I'd like to auto invest. So we'll do $10 here, and then the frequency. So I'll do it monthly to align with my pay cycle, and then you're done. It's that easy. And that regularly just goes through. You don't have to worry about prices. You've already thought about it. And then if we go back to have a look at the pre-made orders, you can click into what investments are included. So So we go back to the main menu, have a look in responsible. It's got these investments, and then global also has a couple. So with Auto Invest, you pick the order, the amount you want to do regularly, and Auto Invest places the orders for you. This is in the Australian market, and if you like the look of that, we're about to launch Auto Invest for US shares, and that'll be coming very soon. So, ready to start investing? Well, you've come to the right platform, that's for sure. So today we've covered what investing is, why people invest, and a few investing concepts to get you started. So if you're thinking about starting your investing journey after today, there's reasons on the slide why you might want to choose us. And also we've got a special promo code for you if you're not an existing investor with us. So if you use the promo code GROW when you sign up to the Sharesies platform, you'll get $10 in your Sharesies wallet ready to invest. And then if you're a little bit unsure about things still, that's okay. Just remember, even if it's a small amount you start with, the time in the market is the key. So we welcome you just to start, and you've got this. Over to you, Brooke.
Fantastic. Cool. So we wanted to make sure there's heaps of time for questions. So it's great to see them coming through. And if you want to ask any questions, just add it in the ask a question part of Crowdcast. So to get started, what's the top thing you've learned that you wish you knew about money investing when you were starting out? I'll start with you, Brendan, and then I'll answer too. What's something you wish you knew about money and investing?
I think when I started investing, it was really hard. You had to go into a stockbroker and like, how much money did I need? How would I feel silly going in there? Would they ask me lots of questions I didn't know? So I think the first thing that I wish I knew was like, you can just start, and it doesn't need to be a lot of money. And it is, although, you know, I've been in the industry decades now, the power of like dollar cost averaging and just compound returns, it's actually magic. You put money in there and it just keeps making money. And I wish I'd kind of known that earlier, that, you know, little baby Brendan put $5 aside a week from the time I was born. That would be, you know, I'd have a lot more money in my bank account than I do now. What about you?
Eh? I know, the earlier the better, eh? I mean, for me, I think I wish I started earlier. I wish there were opportunities too, and it's so great that we're part of creating Sharesies, but there's more investment options and platforms too, because it was, like Brendan said, pretty much going to brokers, and who had those kind of details? Not many people. So, and they didn't really want to play it. You know, they didn't want to have money that was less than probably minimum $10,000. So it's really different now, which is fantastic. So I think for me, what I really enjoyed, I studied finance at university, and that's where I learned a lot about that time value of money. And it goes back to that last graph that Brendan showed, which like the most valuable aspect of money is time. And so being able to use that time with no matter how much you've got to start building and developing wealth would have been great. So pretty much same sentiment as Brendan there.
I think that time thing's interesting too, Brooke, because then you think, oh, maybe I should have started investing when I was 15 and now it's too late. It's never too late. Like, the best time to start investing was 20 years ago. The second best time is right now. Like, you know, it's just getting in, not being scared about it, start investing, and get confidence, get a habit going. So it's never too late. Exactly.
Yeah. It's just, get in that habit, eh? We've got another question here. We've got quite a few. Since I started my Sharesies account, the market hasn't been great. How long would this normally last? And when would it be expected that my returns would start to earn some, when my investments start to earn some returns?
That's the $1 million question, I think. And lots of commentators are unsure. So the markets absolutely move in cycles. If you look, there's a great chart that Vanguard's done, which shows the market returns for, I think, like 100 years or something. And if you look at particular times like COVID, the GFC, there's a big drop in the market. But all things being equal, the market is going to keep delivering. And the companies which have great products, if you look at Woolworths or Coles, they're still doing the same. They're still selling product. They're still having loyal customers. People are still spending, even though lettuces cost $12. But the story is good. The management is good. They're still going to be there. But the share price of companies is not only impacted by what the company's doing, but more and more globally, anything globally impacts markets. So we see conflict in Ukraine, geopolitical stuff, COVID, natural disasters impacting share prices. So unless the company is fundamentally flawed and it might go out of business, you've got to think that those companies will recover. And markets do go in cycles. I think the GFC, it was a massive drop. The beginning of the pandemic was a massive drop, and the markets have come back from there. You've just got to think about like your long-term, why you invested in the first place, which should be kind of a 10-year horizon. And in 10 years, all things being equal, the market delivers around 9% return if you also reinvest your dividends. That's over time, but there are big fluctuations in it. So with a 5-10 year horizon, things should be better, but no one can give you an absolute, if anyone tells you the market's going to turn around in 2 months or tomorrow or the next day, they're just guessing. So that's just the nature of the market, which is why it's so interesting.
Yeah, and it was at a recent Share Club where someone that was presenting there said, they recommend that you just zoom out at times when there's market fluctuations. Like, are you happy with the investment choices you've made? Are you sticking, and then sticking to that strategy and like zooming out and looking at that long term? And it kind of goes back to that graph I showed over the 5 years. And when you zoom out, you're like, okay, there's, the market has been going up, but if you look in certain moments, the markets do move quite a bit. And it's great to see somebody in the chat say, well, I've been investing for Sharesies for 6 months and earning returns. So it really depends on what you invest into and how that how you structure your investments. Another question we've got is, what are the major investing red flags that someone needs to know prior to investing?
I think first, like we kind of talked about having an emergency fund first. So I think the first red flags are, why are you investing? So if you've done a budget, you've paid down any debt that you might have, you've got some savings and emergency fund, and then you work out you've got this extra money and you'd like to invest, which is a great thing to do. So the red flags are why you're investing, like how long is your investment time frame. Some of the investing trends you look at, like, it feels like a bit of FOMO. So it's like, I might miss out if I don't invest, and everyone's making money on X, Y, and Z, and that stuff. It's like those for me feel red flags, because it's like that fear of missing out on the quick buy and sell mentality. I think investing is really like 5-10 years, building wealth over time with amounts that you can involve. So it's like in companies that you know and love. So ETFs are really good from invest and get diversification, have access to a whole lot of stuff. And then companies that you know the story of, everyone buys the products, those are the things you should look at. So if someone's trying to sell you something real quick, that for me is a red flag. Whereas if a company's been around, it's got a good story, I think, wow, those the new iPhones are going to sell like hotcakes or something like that, then I might look at the company that produces those.
And like outside of, regulated investment platforms and regulated investment options, if you're getting phone calls and be like, hey, from random companies saying invest in this, maybe be really careful of that. There are a lot of scams out there in that regard too. So that's why it's important when you're looking at investing, looking at those ones that are through regulated kind of platforms and things. What makes a Sharesies platform different from other offerings?
Well, we're amazing for number one. And I think our platform has this real focus on long-term investing. So, and the way that we've done that is like, we think that everyone should be empowered the same way. So someone with $5 has the same money opportunities as someone with $5 million. So we don't want to talk jargon. We want to make it easy to access the markets and give you choice in what you invest in. And we do that by offering low brokerage and access to over 8,000 different investment options on the platform in New Zealand, Australia, and the US. And we do that in a way without jargon, without talking down to anyone, and providing, I think, really excellent educational content, access to webinars like this that just take you through the investing journey. We also are the only platform that fractionalizes Australia, New Zealand, and the US. So that means you don't have to buy a whole share. You can buy one cent of any share on any of those markets. And what that means is that you don't have to worry about losing a larger amount of money. So you can buy $1 of a share, feel like you're an investor, start following the company, get used to how the company's performing, how it feels like to be an investor, and increase those amounts over time. So it gives you a real ability to have less fear, really, but still have access to those investments.
Yeah, I'm spot on. It's like we set out to really give someone with $5 and $5 million the same money opportunities, and I think it's fundamentally different to what others really focus on. And it's so much fun doing what we get to do. Next question. I'm 19 years old and I started investing with Sharesies about 4 months ago. Oh, kia ora. Awesome. I don't understand how profit is made. I understand the value of a company increases and therefore so do the shares. But how do I reap the capital gain or any returns? I just don't understand how that works. For instance, does the money get put into the Sharesies wallet or into my everyday account?
Cool. So with shares, you can make money in two ways, really. The capital growth of the shares. So you buy a share at $5, and then over time, that share is worth $10 because the company's worth more and the market values that. Companies also can redistribute profits to shareholders, and they're called dividends. So lots of some of we call them blue chip companies. So your banks and Telstra and big companies that have a good product which has many customers and money's coming in, they'll redistribute those products. So that's a dividend. The dividend will hit your Sharesies wallet, and there's a nice transactional report in there, so you'll also get a nice little message from us saying, hey, congrats, there's some money in your Sharesies wallet, you've received a dividend, and you can choose to reinvest that in the company, or you could buy other shares with it. So that's kind of the two ways that you make money through shares. The capital gain stuff, not tax advice, but we provide a tax statement at the end of the year talking about how your investments are gone and any kind of buys, sells there, and give you all the information that you need for your tax return.
And happy investing there. How do I take advantage of the compound interest if we just buy stocks and leave it there for the long term?
Yeah, so really important to reinvest dividends. So the way that I look at getting compound returns in the share market is the price. So you get a double kind of benefit with investing in shares, because shares, everyone hopes that the shares go up, so you get the increase in the capital value of the share. And then say, a utility provider gives me a couple of dividends a year, and then I buy more shares in that utility provider with those dividends. So you're reinvesting the dividends, because dividends are like interest in a bank account setting. And if you keep reinvesting those, that capital growth of that company will keep going, and they'll hopefully keep paying more dividends, and it just keeps adding up.
Yeah, and we've also got a question saying, can I automatically reinvest those dividends on Sharesies? Not just yet, but that's awesome that you want to do that and want to see that automatically happen. So we'll definitely feed that back to our product team. Another question we've got is, can I invest my under 18 children in their name through the platform?
So in Australia, that's definitely a product feature which we want to do, because we think, and as we've said, investing early is a great way to go. I know my family in particular, my 12-year-old nephew is in New Zealand, has his own Sharesies account, talks about investing all the time. So it's a really great way to get kids involved. So that's absolutely something that we're looking to do, because we really see that that's a powerful way to grow kids' wealth.
Exactly. Cool. I'm just going to check if there's any more questions coming through. I saw one here. Are we looking at adding emerging markets in our platform? And we're always looking at ways that we can provide access to investments that people want to get access to. We've got right now over 9,000 investment options on our platform, and what we're looking at doing is how we make those more help people get that habit, like we have with Auto Invest and some of the examples that came up today. But if there's emerging markets that you're really interested in and want access to, we will look at what we could do there. But we do actually provide access to some emerging markets exposure through some exchange traded funds that are listed on the platform. So if you search and invest and you go emerging markets, you'll see some funds there that actually invest in in emerging economies, essentially. Businesses in emerging economies. Got another question. I want to ensure I only invest in ethical and sustainable companies. Does the responsible tag on the app filter only include sustainable, ethical companies and exchange traded funds? And if so, what criteria does that company need to meet to be included in that tag?
So ESG is super popular. So actually 20% of our funds under management on the platform and ETFs relate to ESG related ETFs. So a good way to go into the Invest tab in the app, and there's a free text search field, and you can pop in ESG, and that'll bring up the particular ETFs which are managed by companies for ESG purposes, as well as things like clean energy, environmental, sustainability, climate change innovation, that sort of thing. And they themselves are tagged ESG compliant fund by the fund manager. And there's a link to the documents in that fund. So you can go and have a look at the website and have an actual dig down into what companies are included in that. There are external bodies that do ratings for ESG. So Sustainalytics is one in Australia, which is pretty good. There are lots of things in ESG. So that stands for environmental, social and governance. So environmental we all know about pretty well. Social and governance stuff can be very interesting. So there are some good external companies that go through and do that. But yeah, it's very, very popular. And I think we did a look at performance of ESG related ETFs, and they're pretty much over the last 3 months particularly, they've done really well because there's a lot more focus globally on actually doing good.
Yeah, exactly. And that's such a great question. Thanks for asking that. Will you have a startup section for people who like to invest in new companies, so startups?
Yeah, and that's part of what we want to do is break down the barriers. So at the moment, how could someone with $5 invest in startups like venture capitalists do at the moment? So that's still a space which is a little bit difficult to get into, but that's an awesome idea, and one that I think I'd love to be able to start investing in startups.
Totally. Do you think there are any degrees out there that might be beneficial to gain a sound understanding of the stock market? I did a finance degree and a master's of finance degree, and I personally think the best way to learn is by doing. And that's another part of why we set up Sharesies, is that to remove those minimums and make those jargon, remove some of that jargon too, so that people can get started with how much they have. And every expert started as a beginner at some stage, and once you're in that market and you're starting to invest and you're looking at what's happening in the economy or what's happening in that company and how is that impacting my portfolio, and all of these kind of, you start to gain that interest and that curiosity just from investing. So I would say, even though I have that degree, I feel like the majority of my investing experience has led me to the most knowledge, I guess. So that's my hot take on that. Will you be able to auto invest in our wallets rather than into a DIY portfolio? Will we be able to auto invest into our wallets rather than into a DIY portfolio? I want to set up a recurring direct debit into my wallet, and maybe once a month I can go in and manually purchase shares.
Yep, you can absolutely do that. So we've got a functionality where your bank account, you can do recurring payments into the wallet and the app, and that money will just sit there for you to pop in once a month. But auto invest is a really powerful way to automate that, so you don't forget, and it's a good habit.
So we'll send you notifications if we see money going into the wallet, and hey, you got money in your wallet to invest if you've got your notifications on. And so we try to make sure if there's money going to the wallet that you're getting it out there, if that was your intention with it. But yeah, like Brendan said, you can go to a wallet, set up recurring payments to or money to go into your wallet, so you can choose when and what to invest in. Where can we research about the share market?
I've got there's a really good asset site called Money Smart, and there's an investing tab on there, and it talks to you about all the different concepts to do with, like, what does the share market do, who operates it, what are shares, how do you buy shares. So it's really good free resources there from ASIC, as well as we've got some great content on our website. If you go to sharesies.com.au in the Learn section, there's lots of blogs there about the share market and how it operates. Lots of online stuff to research, but I would start with Sharesies, of course, and also the Money Smart site, which ASIC has done.
Next question. Worst case, Sharesies goes down. What happens to our stock? Is it secured and put back into our own account?
Yeah, so you own all your shares on the Sharesies platform, and it's held in what's called a custodial HIN, which means that there's a trust structure around there. So that property is your money, and it is completely protected. It doesn't form part of Sharesies as a company. And we're also regulated by ASIC in Australia, and in New Zealand we're a market participant, the FMA regulator. So financial services, money's very important, and you need to trust the company that you're dealing with. And there's lots of regulations and safeguards to do that.
Yeah, and yeah, exactly. And so the money, your investments are fully owned by you. And so if anything did happen to, say, Sharesies the company that all of your assets and money is ring bound and secured for you. So no need to worry about that. We also had another question about, will we consider accounts parents can open on behalf of their kids? And as Brendan said, yep, definitely that's something that we're looking at and working on at the moment. Where can we, what's the best way to find out which companies pay dividends?
In the app, actually, you can
Yeah.
you can go into the invest page, you can search for a company, and then there's a dividend yield. So that kind of shows, how much dividends they've paid, and the yield is like the percentage on the share. Also, companies on there, if you're really interested in following a certain company, their company websites have all that. But in the app, you can absolutely find that. And again, the sorts of companies which pay dividends regularly are these kind of blue chip type ones. So if you look at the ASX top 10, top 20, those are the sort of companies that have profit that they start redistributing to customers. But absolutely go on the app and have a look at that dividend tab.
Next question. What are the reasons why we aren't able to do that automatic reinvestment of the dividends so they don't have to micromanage their accounts? It is something that we're working on. It's technically a little bit more complex the way that we're set up. So really great to have that feedback and know that's what you want, and we'll make sure that that's prioritised more on the product roadmap. So thank you so much for sharing that. Do I need to apply to trade in American shares? So when you sign up to Sharesies, you get access to those exchange, those shares, so US shares, Australian shares, and NZ shares, and the app actually will just take you through a bit each time you want to go into one of those investing in one of those markets. It gives you a bit more insight in terms of what that means and how to go about that. So that's all through the Sharesies app. Another question: is there a way to add stop loss?
Yeah, so again, different types of orders. So you can do a market order at the moment or an at-limit order. So market order is it will go into the market and it will get whatever the market price is, which isn't necessarily the last traded price, because you might have someone trying to sell a share and buy a share. But you can do an at-limit order at the moment, which is the most money you want to pay. So if you say, okay, the market, the last price was $8, but I want some shares, and the most I want to pay is $7. That will sit there until it's filled. And then a stop loss function is like you've already got shares, and you might think, well, and the market's a bit choppy at the moment. I bought these shares for $2 5 years ago. They're worth $10 now. If the market in that company goes down to $8, I would like to get out then. So it's kind of a stop loss function. We're absolutely looking at different types of orders. So we'll have a chat to our awesome product team and get them to pop that on the roadmap.
Hey, Brett, is there any chance to share the slides again? And that last one with the time in the market being time in the market? Because the next question is, I'm only investing a really small amount per month and have had little to no return. Is it even worth it? And I just want to really show this graph to you, Lauren, because it just shows the power of time. So it doesn't matter how much you're starting with. I think this example is based on around $25 per week, but it could be $5, it could be whatever that feels right for you, and works in your financial realms. But it really can add up over time based on these things that we're talking about. Two things, which is that the capital gain, so the price of the shares can go up over time, as we've seen with that S&P 500 over those 5 years. It has gone up quite significantly. And the other is those dividends. So some companies or funds you invest in might be paying, or companies you're investing in might pay out dividends, and those dividends can, then you can reinvest them and invest in. It's kind of like it's compounding returns, kind of like compounding interest, where that money grows money essentially. So don't be disillusioned by how much you're starting with and the time it can take to start seeing that grow over time. That is, like I said, one of the most valuable things I did learn when I studied finance was that time value of money. And I was like, whoa, how are we not taught this at schools, and how is this not something that is shared so universally? And I think Brendan even referred to it as Albert Einstein calling it the eighth wonder of the world. So it's just really important to realize that it doesn't matter how much you're starting with, just putting that money away and building that habit is a great way to develop wealth over the long term. Any other questions we've got?
And that one's a good one for you, Brooke. Is now still a good time to start investing even though the market is down?
It goes back to that graph again, and the title of that last slide we just showed was "It's time in the market, not timing the market." And Brendan talked about dollar cost averaging, like investing regularly, and so shares can be going up and down, but if you're investing regularly, you're kind of essentially dollar cost averaging. And so really I think somebody said the other day, if you're the best time to invest was in the past, and the next best time is now. And I think that's more about making sure that we're making the most of that time that we've got. And so yeah, it's and again, it's coming back to those principles of understanding your risk, understanding your goals, building that diversified portfolio, and taking that long-term horizon.
I also like to think sometimes when the market goes down, it's almost like those companies are still the same companies. They're still selling the same products. They've still got loyal customers. And it's, I think, if I went into JB Hi-Fi and I'd been looking at an iPhone for a while and say an iPhone is like on sale, that's a good thing. It's not necessarily a bad thing, because there's quality companies that have great products that have a great trajectory ahead of them. And dollar cost averaging, it's a good time to get in cheap potentially.
Next question that's been upvoted. Will Sharesies be listed on the Australian Stock Exchange? So at the moment we are a private company, and we've always said, in the future we would love to see people be able to buy shares in Sharesies. It's not something that's in the near term at the moment, but thanks for showing that interest there. Just checking if there's any more questions to come through. So many great questions here. It's fantastic. Considering markets dips and the risks, is long-term investing still more reliably beneficial compared to fixed-term accounts or high-yield accounts?
I think, again, if you look at the historical returns from those sorts of assets, there's a great chart that Vanguard does. I think it's over 20 years, and it looks at the different asset classes. So Australian equities, US, property, fixed term deposits, that sort of thing. I go have a look at that, just type in the Vanguard asset return, or we might actually send it out. It's really good. Like over time, the share market has consistently returned that 9% with dividend reinvestments, and other asset classes are usually lower than that or fluctuate much more. But again, diversification is not only just putting all your money into a diversified share portfolio, it also could be spreading that over different asset classes. So obviously, again, cash is secure. You can go to the bank and pop it in, and an interest rate might be 2%. But then you've got much more ability to earn greater returns in the share market over time, all things being equal. But it's having a mix of those investments and the types of investments that you might be comfortable with.
Great. I've got time for one more question. And the question I found is, are there management fees if I purchase an exchange traded fund through Sharesies, or is it deducted from my return?
Cool. So when you buy an ETF, you get charged brokerage, which is 0.5% on amounts up to $3,000. So that's on all the things. ETF providers, there's a management fee within the ETF, which is based on the fund and then the returns that they give you. And all those management fees are clearly documented in the app when you go to purchase it. And some of the ETFs might charge a higher fee because they might do some active management, or there might be something there. But then there are things called passive ETFs, which just track an index. They often have lower fees. So fees can make a big difference in returns, particularly over decades. So definitely have a look at that. But all that information is within the ETF providers' websites.
Cool. Hey, that's a wrap. Thank you so much for coming along today to listen a bit more about Investing 101, and hopefully we answered as many of your questions as possible. Again, you can always reach out to us on Instagram or Facebook or help@sharesies.com.au. We're really here for you on your investing journey. And yeah, happy investing, and stay tuned for the next event to come. Okay, see you later.
Thanks, everyone.